All right, why don't we go ahead and get started? So thank you very much for joining. I'm Mark LaMonica. I look after the individual investor team for Morningstar here in Australia. Today, we're going to talk about a portfolio checkup. It's a good time to do that. But first, a couple of things. Number one, you can follow us on Instagram if you would like, and you can listen to our podcast, Investing Compass. And we have another one. You can come to our conference. So we have our conference on Thursday, the 3rd of February, as you can read on the screen. And we've got a great group of speakers. If you would like a very discounted / free ticket, send me an email at mark.lamonica1@morningstar.com, and I will send you a free ticket. The whole conference will be recorded as well. So if you can't watch it all during the day, you can go back anytime in the next 30 days and review the different sessions we have. Plus, I'm emceeing it, which is, not a good reason to watch. But anyway, that's our conference. So before we get started, a couple of housekeeping items. So number one, anything you hear today is general advice. I don't know anything about you, so I can't offer personal advice. If you happen to be over in New Zealand, then you can go on our website, morningstar.com.au, to get a copy of our FAP. And the New Zealand regulatory authorities would encourage you to speak to a financial advisor if you want personal advice. Also, this will be posted onto our YouTube channel. So anyone that would like to watch this later, go and do that. And also send through questions. So there's a Q&A button on your Zoom screen. There's also a chat function. If you have any questions, that would be great. Just send them through. All right, so let's get started. So we're going to do the New Year portfolio review. And this is our celebrity guest today, Michael Jackson. And, we're starting with, if anyone's listened to any of Michael Jackson's music, Man in the Mirror. So we're going to start with you. So before we get into any sort of portfolio check, we need to start with you because, of course, investing is all about you. We have this saying at Morningstar that we are about the investor and not the investment. And that's the way you all should think about your own portfolios, right? The most important thing is achieving your goals, not necessarily whatever share or ETF or fund or anything else that goes into your portfolio. So how should we start off? Well, number one, goals. We are very into goals-based investing here at Morningstar, and we are into it because it works. So setting a goal obviously gives you something to work towards, gives you a measurement of progress towards your goal, and it just provides structure around the whole investment process. So everything from asset allocation to selecting individual securities. So have your goals changed? So number one, do you have new goals? Or has anything changed about your goals? Whether that's the amount of money that you need for your goal, the timeline, anything related to a goal. Spend a minute thinking about that. And then your financial situation. So has there been a material change over the course of the year to your financial situation? So that could be increased expenses, that could be increased salary. So for anyone who listens to our podcast, Shani's actually in the room today, which is exciting. Emily is also in the room. Emily just joined the team and she had the misfortune of going out to lunch with me today. But Shani and I did a podcast where we talked through this. Shani got promoted last year, which obviously is a great accomplishment, but that was an opportunity for her to take a step back and think, okay, can I save now more for my goal? So same thing, go back and look at what's happened over the year. Have you gotten more income? Hopefully, have your expenses gone up for any sort of reason? Because that, of course, can adjust the amount that you're able to save and invest towards your goal. And then obviously important to look forward. So do you have any plans in the upcoming year that will impact your finances? So just an opportunity to sit down and think about this. If you are retired, it's also an opportunity to sit down and think about how inflation has increased, probably not decreased given where we are now, but increase your expenses. And when you're thinking about your withdrawal rates from your portfolio, is there an inflation adjustment that you need to make and how much is it? So, generally, we measure obviously inflation with CPI, this basket of goods. Generally, people's personal inflation is different from that. So you should make an adjustment based on your personal inflation. So this ends the celebrity portion of the webinar. So say goodbye to Michael, strangely staring at himself in the mirror. Okay, so next thing to do is, as I was saying, why are we investing? We are investing to try to reach our goals. So you should check your progress against your goals. So there are three things that will change your required rate of return. So hopefully for people that have attended these other webinars, you understand what the required rate of return is. So very briefly, what that is it gets you from where you are to where you want to be. So that is a return that you need to earn on your portfolio, however much is in it right now, to get to that target amount for your goal. And that obviously takes into account a couple different factors. Number one, how much you're going to save and invest over that time period. And then also, of course, the length of time between those two periods. So as time progresses, so let's say it's been a year or a half year since your last check-in against your goal, the first thing that's going to affect that required rate of return is the passage of time. So time, as we say all the time, is one of the really important things in investing, because of course, the more time you have, the more opportunities you have to compound those returns. So as time passes, all else being equal, your required rate of return is going to go up, because of course you can't get that time back. So that's the one thing that's going to affect it. The next thing, of course, is your savings. Now, your savings, if you have put into, and I'll go to our website in a second and show you how to do this. If you put in a savings plan into that required rate of return calculation, into our goal feature, if you're a premium subscriber, if you put savings into that, then you need to compare your savings to what your plan was. So that will obviously be incorporated into the calculator that comes up with that required rate of return. So compare your savings to what you said you're going to save. If you exceeded your savings goal, all things being equal, that will bring your required rate of return down. It will lower it. If you fall short of your goal, all things being equal, that will raise your required rate of return. And then, of course, if you met your savings goal, then there should be no impact from that input. And then, of course, the big one, the third one, is your portfolio returns. So depending upon where you are in life, those returns will matter a lot, or maybe not as much. So if you are younger, you have a longer period of time, you're going to save more money, then savings, your ability to meet your savings goals, exceed your savings goals, are going to have a huge impact because your account balance is likely lower. You are later in life, approaching retirement, your savings are not going to be very much compared to what's actually in your portfolio. So what is going to impact you then? Well, it's portfolio returns. So same thing, and this should be intuitive, but we are measuring ourselves. We are measuring the success of our investments against the return we need to meet our goals, not against our neighbor who invested in Bitcoin, or not against some guy that you ran into at the pub who told you about all these great shares he bought. We are measuring it against your goal. So if you have a higher required rate of return than what you need to achieve, or higher return than your required rate of return, then of course your required rate of return will go down. It's lower, it will go up. Same, then it will stay the same. So that's how we want to evaluate progress. And there's obviously a lot of different ways that people evaluate progress. I went through the tongue-in-cheek examples of comparing yourselves to other people, which of course none of us do, right? We're all very confident and we don't look at other people at all. But the other thing, of course, is people measure returns against benchmarks. And that's obviously the way that the financial services industry measures success against a benchmark. It's generally not a great way for you to measure success because, number one, what benchmark do you choose? Does it really matter if you exceed the benchmark or not? Certainly doesn't if you need to take on less risk to achieve your goal, for example. But that's why we like putting structure around this process and comparing your success against that required rate of return. So how can you tell you're on track to meet your goals? Well, we'll move on to the next slide. How about that? All right, so I've taken screenshots from our website because, we built it and I like it. But you can also do this, obviously, with a financial calculator, do it in Excel. But recalculating your required rate of return shows you if there's progress. If you have the same required rate of return that you had the year before, then you're on track to reach your goal. If that required rate of return goes down, so you need less return to meet your goal, then you're ahead of schedule. And of course, if it goes up, you're behind. And the degree to with which it changes is obviously a big factor, which we'll talk about in a second. But what I'm showing here is just an account called Retire Early. So this is the original setup. So I drop this thing into our goal as an example. So you can see all the inputs originally. So no additional investment, how much money have, how much money you want in the future, how much time it is. So that tells me that I need a 9.81% return. I will say that that's very aggressive. Perhaps this is a very bad example. That would be difficult to achieve over a 19-year period, especially after fees and after taxes. And then we have this functionality where you click on update goal. And basically what that's doing is automatically recalculating that every day. So, and I don't recommend you look at it every day, but every day it will recalculate that based on changes in portfolio value, based on any savings that, of course, you put in there and invest, and based, of course, on the fact that the time frame to the goal is slowly reducing. So you can see in this case, 9.81% went down to 8.98%. So that is an example, of course, of being ahead of schedule. So you can obviously do this on your own, but just a little premium tool that I think is helpful. All right, so what do you do next? You've sort of gone through this whole process. You have gone through this whole self-assessment. Has anything in your life changed? You've looked at progress towards goals. So now what do you do? Well, the first thing you do is you want to think, if your required rate of return changes, are there any changes you want to make? Now, this is where we have to talk about the levels of change that potentially have happened to it. If there have been very small marginal changes, then yeah, you probably don't need to do anything. There have been very large changes, particularly if that required rate of return went up significantly, then you might want to go back and look at your asset allocation. So asset allocation, of course, and on Tuesday, 2 p.m., we've got a whole webinar on asset allocation, but asset allocation is the mix of different types of securities that you put into your portfolio. So at a high level, what we're looking at is growth securities and defensive securities. So growth securities, you are exchanging risk in terms of volatility, how much that price bounces around, for a return. That is what investing is. Right? We are exchanging risk for return. And as investors, we need to evaluate whether we are getting an appropriate expected return given a risk level. So that's what we want to look at asset allocation. So we've got another tool here where you can go in and save an asset allocation target, and then it compares it to your portfolio. And that allows you to look and see if it is drifted. So what is going to change? So let's assume that you've gone through this goal check. You don't need to change your asset allocation. So why would this change? Well, of course, it changes because of security price movements, especially relative security price movements. So, very simply, if you have a 50-50 portfolio, 50% shares, 50% bonds, and shares go up by 20% and bonds go down by 10%. And I'm not going to pretend to do the math in my head, but all of a sudden your asset allocation will be out of whack. If you're trying to get that into 50-50, all of a sudden you will have a lot more allocated to equities than you will fixed interest. So this is where the concept of rebalancing comes in. And that is simply taking the portfolio where it is and getting it back to where you want it to be from an asset allocation perspective. A couple of things about rebalancing that I'll just sort of drop in here is, number one, obviously do not do it too frequently. Number two, look at the degree of change. If you want 50% shares and you're at 52% shares, you should probably just leave it because rebalancing does have detrimental impacts to you. Number one, and this depends upon what account this is in, the degree of taxes you have to pay. But yeah, number one, it will automatically trigger taxes in 90% of the situations, right? Because generally when you're rebalancing, you're of course selling things that did well, and you are buying things that did poorly. Things that did well will have capital gains tax. There are situations, of course, where everything goes down, but we're going to hope that we're not in that situation right now. Although, yeah, well, you guys can look at the market. So yeah, rebalancing, remember, you're going to pay taxes. There's also transaction costs. So transaction costs, and remember, transaction costs are not simply the brokerage you're paying if you're trading shares or ETFs. There's also that bid-ask spread, or what do you guys call it? Bid-sell spread in Australia. I should know that. Buy-sell spread. So this is why it's nice to have people in the room. They can tell me when I'm wrong. Buy-sell spread. So there's all sorts of different transaction costs. So think about how to rebalance in the most efficient way. So if things are not that out of whack and you are continuing to put new money into your account, then maybe you want to buy different things. So in my example of shares and bonds, if shares become a higher percentage than you want, then all of your new contributions over the next year could go into bonds. So there are ways to do this without actually buying and selling and triggering those different costs that you want to avoid as an investor. Then, of course, you get to dive deeper into your portfolio, which is always fun. Oh, we've got questions, which is also fun. All right, so we've got the anonymous attendee, which is my favorite attendee. I wish I could go through life anonymously. Do you know if rebalancing within an industry super fund generates taxes? Well, that of course depends upon your own tax situation. You do pay taxes on super. So those taxes are less than taxes you would pay on non-super accounts, but yes, rebalancing would do that. So whether your fund is doing that automatically for you or not, that will it could generate capital gains depending upon your situation. So we've got a question from Angus. So Angus says ETFs are just considered as Aussie equity though. Is there a way to break down an ETF portfolio to look at how it contributes to a balanced personal portfolio? There is, Angus. So that is a good question. So now we are going to travel to the internet. So first I have to make sure that I don't have some sketchy website up. It's actually not sketchy. I have Shani's expenses that I was approving today up there. Now her expenses, yeah, I know. Her expenses might have been on sketchy things, but I'm mostly concerned about myself. So, all right, so let me share our website. There we go. All right, so the question that Angus is asking is that, of course, when you invest in an individual share, it's very easy for you to figure out what is in that, what's that share is. Is it an Aussie mining company? Is it BHP, for example? A little harder with ETFs, but what you can do is you can, of course, go to Morningstar to help you. And I'll show you two different things on here. So the first thing we want to look at when we're looking at an ETF, let's pick a ridiculous ETF. We'll pick ATDC. I think this is a ridiculous ETF. So apologies if anyone owns it. I will say it's gone down a lot since we said on the podcast it was a ridiculous ETF. Every once in a while, we get things right. All right, so on all of our ETF or funds, if you look them up, there is this tab called Portfolio. So what portfolio is, and then I'll show you, Angus, how you can do this on your whole portfolio. So what portfolio is on here? Sounds a little confusing, but basically what we're doing is we're looking through that ETF. So an ETF, of course, is a basket of securities. And because of the data we have, any funds, you can do this with funds as well, funds and ETFs, we can look through and see what it's actually holding. And this is where you have the opportunity to go and look at a number of different areas you want to analyze this. So very simply, the question that you asked, Angus, is, yeah, where is it invested? So we can see here with ACDC, if you've invested in this battery tech ETF, 90% of it or so is in global equities. We've got around 9.5% in Aussie equities, and there's always a little residual cash, except in my wallet. but there's always residual cash in ETFs. So that's where you can go in and see the breakdown. You can go down and look at all sorts of different categories, right? So we'll go through some of this style, so you can look at where this fits from a growth to value perspective, from a large cap to small cap perspective. I like it when I click on things and they don't load. It makes me really happy. But anyway, you can go through and look at all sorts of different measures. What are things like the price earnings ratio, et cetera. You can look at sector allocations. How is this allocated in sectors? The other thing you can do is you can, of course, do this on a portfolio level as well. So what this allows you to do is if you own multiple ETFs, if you own multiple funds, if you own individual shares, it allows you to go in there and see, is there overlap? Number one, what is your overall asset allocation? This is the step we're on right now. So basically, I'm just going to show you this live. What I had done on the slides is I had copied and pasted something out of the website, but I'll show it to you live. So what I've done is I've gone in and I've looked at this portfolio. So once again, we're looking at all these different measures, and I'll talk them through. But I did want to quickly, Angus, because I think maybe this is relevant, is go to stock overlap. And I don't know what I put in this portfolio, by the way. So maybe there's nothing interesting in it, which could be a problem. But yeah, basically that'll show you overlap. So you might think you're really diversified because you've gone out and you bought like 8 different ETFs. I'm guessing there's no ETFs in here. 8 different ETFs, but they could all own the same shares, right? And we particularly are seeing that now that we've seen so much dominance in global indexes and US indexes, in sector indexes with technology. So yeah. All right. So let's go back to the PowerPoint. I actually have a portfolio in a different account that I need to log into that will do this for you. So I'm going to multitask, which will not go well. I can barely do one thing at once, but let's go back to this PowerPoint and I will try to open up that other portfolio and log into it. All right, so what are the things we're going to look at? So I am on that page. I'm on that X-ray page right now, which is what I've cut and pasted into it. So the first thing that pops up, sort of on the right-hand side of that screen, is stock sectors. All right, so why do sectors matter? Well, so what are sectors? Number one is we are just grouping together similar companies. So companies that have similar traits. So we've got sectors underneath there are actually industries. So there are 11 sectors. This is not a Morningstar thing. This is just a investment thing. So all companies fall within these 11 sectors. And what we do at Morningstar is we take those 11 sectors and we actually group them together based on how they respond to where we are in the economic cycle. So, simple examples: cyclical. Cyclical means companies are very impacted by where we are in the economic cycle. Defensive means we're not really impacted at all. So let's use a couple examples. Why don't we use basic materials? Because we should care about basic materials in Australia because it makes up so much of the local market. So basic materials, think miners. So basically basic materials are inputs that generally go into construction. So iron ore is an example, right? Get iron ore, you make steel out of it. You take steel, you make a building. So very simple. So why is this cyclical? It's cyclical because construction is cyclical. So generally as the economy is revving up, we see lots and lots of construction. We see investment by businesses to try to take advantage of what's happening with the economy. So we see a lot of construction. So generally that's very good for basic materials. Conversely, when the economy starts contracting, so think about what we're seeing in China now. So China is slowing down significantly from an economic perspective. It used to be that every quarter China had over 10% economic growth or 10% GDP growth. Now what, we're at 4 something. So there's been a big slowdown. We've seen the state really stop doing a lot of what they used to do to respond to slowdowns, which was just build a bunch of stuff. We'll just build more roads and railroads and cities and everything else. Well, Chinese government's backing away from that. So That is bad, obviously, for basic materials companies, not great for Australia, right? So we've seen this. If we've looked at the iron ore price, where it was last year, where it is now, that's negative. So that's cyclicality. Okay. And sort of globally, if we look at where we are, we're seeing decelerating growth kind of around the world right now. So we had this sort of boom coming out of COVID, right, as economies opened back up, and there was huge fiscal stimulus, there was government spending, there was huge monetary stimulus, central banks lowering interest rates, pumping money into the market. Seen a lot of that go away. So we're sort of getting into decelerating growth. The other example we have, of course, is defensive. So what does defensive mean? It means it doesn't really matter where we are in the economic cycle. It's not really going to impact the companies there. So healthcare is a simple one. You're not really sitting around waiting for a good time to go deal with whatever you're dealing with from a health perspective. I would list all my problems, but we don't have that long for the webinar. So that's something where spending would stay pretty much the same regardless of economic conditions. So once you've done that, look through your portfolio just to see. And, more than anything else, more than doing anything, it's important to understand what you're invested in, because that will allow you to understand why different things are happening. And hopefully that understanding, so as economic conditions change, as your portfolio does good or bad things, understanding why that's happening will hopefully prevent you from doing something stupid, like panicking and selling everything, or rushing out and putting all of your money into iron ore when it's at the highest price it's ever been. So what you can do is you can go look in our Monitor Markets page, and you can look at sector performance, which gives you an indication of how everything's done. When you tie that back to your portfolio, you can see, oh, it makes sense that my portfolio has done really well because I've invested a lot in this sector, which has done very well. You can also look at valuation. So basically, valuation looks at our analysts, what they think about shares in those individual sectors, and it rolls them up to the sector level. So that can tell you if something's cheap or expensive. All right, so that's sectors. We have a question from Rodney. Rodney's questions are always very complicated. And that's not a criticism, by the way, Rodney. So question on the portfolio tracking X-ray IPS asset allocation comparison tools. In my case, it gets things wrong because there's a number of my holdings which Morningstar doesn't recognize support, Chi-X holdings. Yes, so that is true. So is there a way to tell Morningstar tool what type of asset each of the holdings are so that it can correctly does the asset allocation? All right, so what Rodney is saying, so we do have, so Chi-X, for those of you that don't know what it is a competing exchange with the ASX. So there are ETFs listed on Chi-X. There's lots of things listed on Chi-X. And yeah, we're having a problem that we're trying to fix with our Chi-X data. So unfortunately, Rodney, what happens is if we can't classify things, it kind of goes into this other classification. And you'll see this little thing that comes up at the top of your screen saying, ABC is not classified. Unfortunately, there isn't anything. Oh, I went backwards. Unfortunately, there isn't anything that we can do about that until we fix the data issue, which we're working on. And I'm sorry. Yeah. So the other issue that Rodney is pointing out is that when you go into share site and you put when you put a bank account in that has cash, it doesn't pick it up as cash. It only picks up cash as a portion of an ETF or a fund, or if you bought a cash equivalent ETF or fund. So I hear you, Rodney. I'm sorry about that. Okay, so let's keep going and we'll get to a couple of the other questions that we have. So the next thing we are going to do, we are going to look at factors. So what are the different characteristics of your portfolio once again, and how will that explain what's happened and also give you hopefully foresight into what are the forces that may impact your portfolio? So we're going to look right here, the Morningstar style box. Very, very exciting. Not that stylish, but very exciting. So what this gives us is it plots your portfolio between value and growth, and I'll explain what that is in a second, and market cap, large and small. So let's start with market cap. So market cap is just the size of companies. So we measure size of companies by how much they're worth, which is total number of shares outstanding times the price. So small market cap, small cap shares, small companies. you can probably figure out what large cap shares are. The other thing that we look at is the spectrum of value to growth. So, right, value shares are shares that have lower valuation levels. Growth shares have higher valuation levels. Why does a share have a higher valuation level? Why is somebody willing to pay more for earnings in a growth share? Because it's going to grow faster, because we care about what happens in the future as investors. So this plots you on this Morningstar style box, on this matrix. So you see here, this is a very value-oriented portfolio. 48% of it is in large cap value. And what we can see then is we can go look and see how different sectors of the market have performed. Now, this is the US market. I grabbed this morning. So for people who have not been paying attention, in the last 3 months, which I will say is a very, very short time frame, there has been a very pronounced rotation from growth to value. So you can see here, large cap down close to 12% US growth, small cap close to 17%, and value is up. So these are big differences in a short time frame. So we have to see what happens. But this is something that you can, of course, look at. You can look at your portfolio in general. Rising interest rate environments, which we're basically in right now. At the end of the day, like a lot of central banks have not raised yet, but they're gonna in 2022. In general, that isn't great for growth. So good opportunity to look at your portfolio, sort of see where you are. Small cap versus large cap. So smaller companies, of course, are less established companies. That makes them riskier. They are riskier because instead of being a giant, multinational company that has all sorts of product lines and has a really strong balance sheet and a great reputation and really experienced management, smaller companies generally are newer companies. They generally do less stuff. They generally have more precarious revenue and finances. So in general, when the market is kind of risk off, which it seems like it is right now, we see some issues in small cap growth in particular, but all sorts of small cap. Then as we are accelerating into a strong economic environment, then we often see small cap doing very well. So once again, this is a classic example of risk and return trade-offs. Traditionally, small caps have outperformed, but they're riskier. So that's an example of what we're looking for as investors. Thank you guys for joining. Lisa says great comment, so she agrees. Vincent, perhaps Vincent owns some alpacas as well. All right, so I'll be back Tuesday, 2 o'clock. We'll talk about asset allocation, and I hope everyone has a great weekend.
Any advice in this video is general advice or regulated financial advice under New Zealand law prepared by Morningstar Australasia Proprietary Limited and or Morningstar Research Limited without reference to your financial objectives, situation or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest. To obtain advice for your own situation, contact a financial advisor.